Bam! Look at this.
Welcome, everybody. We are so excited tonight to have a special support call. We've got Scott Horn in the house from Texas, answering all of your questions, sharing his expertise and his knowledge. So thank you so much, Scott, for taking some time out of your busy day to come and hang out with our crew here. I love our community. We are helping sellers in their crazy situations and trying to, make some money along the way.
Yeah. And all of you guys thank Donnie for reminding me that I had this thing. I've already told Joe and Jen this, Donnie. So, woo,
I appreciate you, Donnie. Thank you so
Thank
much
you.
for reminding
things
Scott.
happen for a reason.
Yeah.
Absolutely.
So if you guys haven't already heard about Scott, met Scott before, you guys are in for a real treat tonight. We've been following Scott for a very long time through Ron LeGrand's World originally is how I even heard Scott. And then after I listened to many, many different podcasts, we connected years ago. It's been a tremendous help to us, been a tremendous help to our community, and that's why we're so excited to have here. So when I call him the best attorney in America for doing this stuff, I don't care if he blushes, it's true. But it's done by experience, it's done by closings and successful deals. And I'm sure you've had more than enough of those to talk about. So we're excited to have you here. Thank you so much, Scott.
You are welcome. And thanks for that intro. None of
Uh,
it was true, but thanks.
Well, guess what, guys? And once again, this is recorded, so it'll be in the portal. If you ever want to watch the training again or have questions, drop them in or watch it in there, the rerun. But if you also have any questions, make sure we're going to put your hand up or drop some of these in the chat. So we're going to make sure these get answered. But Scott, can you just give us a little bit of a background of who you are, some experience that you've had, and we're going to dive into a lot of creative finance. So, subject to wrap mortgages and seller financing. And so you being an investor and an attorney, this is going
So
to be
besides being the greatest attorney in the world, huh? Yeah, whatever. So guys, been in this business for a long time, 35 years or more. That's how you earn all this white stuff up here. One day I'm gonna dye my hair blonde, more like Jennifer's, I think, but we'll see. Um, but everybody thinks that you get involved in this business because you are an attorney. The answer is no, it doesn't work that way. It's really hard work. Because I go back to the 80s where I had a job for one whole year, just happened to be with a real estate developer here in Dallas. And the first real estate crash hits in 1985, 86, and the whole world comes undone. And you're on the street trying to learn how to fend to eat because what you don't know when you're young and stupid is people aren't hiring you in the middle of a major recession. Anyway, throughout the time, one thing leads to the next, and we buy our first house probably back in 1988, not having a clue what to do. Pipes froze on Christmas Eve of all great times to do that. I'm in church. My pager, that tells you how long ago it was, goes off. They tell me there's water around my front door. And of course, the whole second floor collapsed down. And it's like, oh my gosh. And that's where most people would run away and just hide under a rock somewhere. But anyhow, I've been very lucky since that first deal to learn how to do this business through the School of Hard Knocks. And since then, we have bought over 3,750 single family homes. Almost all those were rehabs. They were bought typically one at a time. We learned how to play the mortgage game a long time ago using creative finance. And in Texas, our rules and regulations keep changing. We used to be able to do lease purchases and lease options without any headaches, and we could do contract for deeds, which you can really no longer do. And we learned how to play the mortgage game, selling the paper we would generate, the owner finance paper, into the secondary marketplace. And today, that is still one of our strategies besides just buy and hold. One thing leads to the next, and when you're closing 400 to 500 deals a year internally, we decided to start our own title operation back in 1996, 97. And having no clue how to do the business, we just started to become a title company. And over 30 years and multiple title operations, we've closed tens of thousands of transactions today, which has been a lot of fun. One thing leads to the next, and we become a asset-based hard money lender in 1997 because we are buying 200, 250 houses a year that are all rehabs. you can't do much more than that without a huge team, and it's hard to let that stuff go. So we figured may as well start lending money. No clue how to do it, but we started doing it. Became Texas's largest hard money lender from 97 through 2009, when the whole world went crazy, as I think we know. And then in 2010 and 11, most of Dallas and Fort Worth here was coming to me going, what do you do? We can't sell our house. We can't cash out. No, you can't get a loan. You can't sell a house because nobody can get a mortgage. And the answer was seller financing. I had probably 130 investors walk away at one time from houses, guys. And you've got to figure out how to put those pieces together, because the only option is fix it or file bankruptcy and walk away. So we fixed it. What saved us, as opposed to everybody else in our industry, was learning how to play the seller finance game. And it truly is. And it's just looking at various time frames is what really drives our industry. Back in the late 80s, interest rates with mortgages back then were in the 12 to 18% range. I don't think any of y'all want to take over a loan at 12 to 18% interest rates back then, when you go to a bank and get a loan at 7 to 8%. Look at what happened in 2010, 11, 12, 13, 14. Rates just plummeted to this huge low interest rate that was maintained falsely low for a very, very long time, which is where we are today, because we have this huge amount of very low interest rates nationally that are ripe for the pickings. And that's what's really driving our subject to industry today, and as well as our owner finance industry today, whether you're in Texas or wherever it might be. Here in Texas, things are a bit more problematic just because of our rules and regulations and our proximity to Mexico. So you got to learn those if you're going to do business in Texas. It's not rocket science. If you're in other states, it's a little bit easier to do it, but you still got to do it the right way, especially if you're going to do a wraparound mortgage, because you better make sure you understand what the SAFE Act says, because you've got to process your consumer home buyer the very first time you do a deal. So been very fortunate, guys, to be a real estate investor, to be a hard money lender. Combined, we've done 7,600 houses together. I've closed over 10,000 creative finance transactions. And all of this, what it means, guys, is it just gives us a lot of experience that we're able to parlay back to our investment community, which makes this business so much fun today. Because, yeah, I've been there, I've done that, I've worked it. We were just talking about, work ethic and whatnot before we hopped on this thing. And I'm just going to share it for a minute, guys, because what I see so much of it in our industry today is everybody wants somebody else to do the work for them. Nobody is willing to do the work themselves, it seems like. They want to pass it off to somebody else because their time is more important than somebody else's. And sometimes that might be true, but guys, I still put in 60, 70 hours a week, probably. And, I was just telling Joe and Jen, when I do seminars here in Texas, I ask questions like, what is the average American work week, which is actually 38.5 hours a week. Then I asked, what is the biblical work week, which is 6 days a week, sun up to sundown, which is about 60 hours a week. If you want to eat, you got to go out, hunt it, and kill it, or you ain't eating. And then I asked, what is the successful work week? And that successful work week is you get the job done when it's done. If you can get it done in an hour, more power to you. If it takes you 100 hours to do the same job, great. If I'm going to go rehab a house again myself and try to install a door, it's going to take me 100 hours to install a door, but my contractor can do it in probably an hour, probably in 30 minutes, but I haven't done it. So you figure this kind of stuff out, you do what it takes to make it happen. And you realize that our job here, guys, is we are real estate investing. This is not real estate job. Real estate job is going out and being a realtor, which is fine to be. It is doing your fix and flips because they're one and done strategies, right? And what we do in our real estate and our creative finance world is we learn how to buy and hold and create opportunity. And sometimes it might take a year before your deal starts making money. It may take 2 or 3 or 4 years. I've got many deals in my portfolio that we bought, seeing the end game is a grand slam home run. The problem is you have to get there. And so you learn this experience. of doing real estate investing, doing the creative finance, doing the subject to and the wraps, and everything else in between. And what is so nice today is when I can blend in the fact of being the investor as well as being the attorney and the title guy together, it really just helps to bring it all together to help guys like y'all understand our business a little bit, what you need to be doing, because been there, done that. We walk the walk. We talk the talk with y'all every day of the week. So Joe, that was way longer than you expected.
I think we all need that reminder. Like we were chatting before, there's a lot of smoke and mirrors with social media, and people are just buying deals on the beach without having to do much work at all. And while we love the beach, that is far from the truth.
No, it's far from the truth.
If I am at the beach, I am still looking at my phone. I'm sure there's still a deal in there somewhere. So I might try to focus on the beach, but there's some times where I've had to stop and pause. But this is the point of what I love about being around great people and great investors. You all have the same attitude as DWIT, which stands for do whatever it takes. Like get the job done, and it's not done till it is. And I've had many stories. I'm sure Scott, you have, and a bunch of you listening have had stories where, man, if you didn't get involved, that deal might not have closed. If you didn't have to go the extra mile, there might have been some things that you know, could have really boogered up that deal. So it's important to make sure that you are going that extra mile because most people don't even go the first mile. So I want to kind of get into some of the things that you're seeing right now, Scott. I know a lot of people will have tips and tricks. We talk about creative finance. That's why they're all here. Obviously, we do get into some wholesale opportunities because they do find those when we're generating all of these leads. But ideally, everybody listening today, they do love that big check from wholesaling, but ideally they want to buy a property that they can buy and either outside of Texas do a lease option. Inside of Texas, they're really wanting to do seller financing. But what are some of the things obviously you're seeing or some things that, people should be aware of?
Yeah, several things. And look, just down here for a minute to get some things to write on. So, oh my gosh, now I go poof in my head. So lease options, okay? So guys, I've owned a mortgage company. I'm in the mortgage industry. I see all this kind of stuff. I've tracked it for a gazillion years. And there's nothing wrong with a lease option, in my opinion. In Texas, you better learn how to navigate it because there are issues. In most other states, there are no issues with a lease option or a contract for deed. And maybe it's called an agreement for sale in your state. Maybe it's called a land contract in your state. The problem is there are other mortgage issues, and so often you need to make sure you understand the foreclosure laws in the state where you're located. Here in Texas, we have a very foreclosure-friendly state. I can foreclose in as little as 43 days on a homeowner. I don't know what it is in Florida, Joe. I know in Arizona it's about 6 months. But
What's your guess for New York?
who's in New York? No.
What would be your guess for New York? Because we still have a lot of properties in New York. That's why I don't do seller financing there.
Never.
Yeah, exactly.
Give them the house.
I don't know. I have no idea. I would bet minimum of a year and maybe longer.
So
California maybe the same way.
California, New York, some of these
That's
states.
why I just don't want to, I wouldn't do business in those states personally. I want to just stay away from those things.
Yeah.
But I bring up lease options versus a wrap. And there's two ways to look at this, guys. If you're going to buy a property from a seller and the pushback is they will not do a subject to deal for whatever reason it might be, or they won't do a wraparound or a mirror wrap with y'all. I get it. You'll run into those kind of things occasionally. Fine. Go ahead. Maybe you do your lease option with the seller. Maybe you do a contract for deed or whatever it might be in your state, an executory contract with the seller. Great. Do it. Do what it takes to get the deal secured. It's just the back end deal. You're now limited to either a lease option or an executory contract in the same format. And the problem with that is it's no longer the seller's homestead. And since it's no longer their homestead, other liens may be able to attach to that property that the seller cannot navigate. That's outside of your control. So because of that reason, I always try to take advantage of a subject to deal or a wraparound transaction And hopefully I know what my rules and regulations are for foreclosure. And I just want to let y'all beware of something called a performance deed. Have y'all heard of that, Joe?
Yep. Due on sale clause.
No, performance deed I'm talking about is
Oh, I'm
where
sorry.
you execute a deed back to the seller at closing so that if you default, they can just deed the house back to their name. Very problematic here in Texas. There's some statutes that kind of prevent that. You need to make sure you check with your state to do that. Okay, that might be a way to work with your seller a little bit in that instance. I wouldn't suggest putting it back in their hands because who knows what they do with that document. You want to put it to a third party escrow agent or somebody if you go that way. So just be cautious. But it's how can I entice my seller to sell me the house using a subject to mechanism, using some type of a wraparound mechanism in that instance. And hopefully you have reasonably favorable terms. And one thing I always ask people, whether it's a seller or a back-end buyer, is have you ever found anybody who wants to get foreclosed on? No. So I'm always trying to find a way to convert the acquisition to a subject to or a wraparound transaction. Now, on the flip side, what I do in my offices and my businesses is all we do up here is we do seller financing to the back end buyer. I've owned hundreds of rental properties in the past. I don't ever want to be a landlord for umpteen reasons. I have owned Airbnbs and maybe the right location, the right various things, you can do it. I just don't want to manage an Airbnb. I have one in Scottsdale because we have a title office in the Scottsdale area. And but it's managed by a third party, not by me, because it's a lot of work and a lot of effort. But when my goal is to sell a home to a back-end buyer versus a lease option. A lot of investors want to use a lease option. And Joe, I know that LeGrand teaches lease option, lease option, lease option, all those things. I get it. But I think you will control a much larger down payment if you can do a sale to a back-end buyer than you will for the lease option for multiple reasons, right? Because when they own the property, first off. So you can command a larger down payment that is no issue about refundability of that down payment. Whereas with a lease option, could you get into a little tiff with the tenant buyer? Maybe. Every state's going to be a little bit different on that, I think. But another thing I will tell you is from a mortgage perspective, if my goal is to buy that house with creative financing and is to cash out through third-party financing to a buyer, I prefer putting the buyer into a wraparound mortgage of some type because the buyer now, it's easier to refinance the deal than it is to get a purchase money mortgage in the mortgage marketplace because you're able to generate a pay history. That they own the property. You get a pay history, and it makes it easier for the buyer to refi than it does necessarily to get a purchase money mortgage. So just something to think about there as you do that. And it does give you more control because it gives you another exit strategy if that buyer is unable to refinance for credit reasons or whatever reasons it might be. After you develop a little bit of seasoning or a pay history on it, that paper is always marketable into the secondary marketplace. So if you're looking for an exit strategy, that might be a way of doing it as well. So that's just one of my preferences when I hear lease option out there. It does by no means, it doesn't mean don't do it. It is a way to collect that $5,000, maybe $10,000 option fee. And then, of course, if the buyer can't close, you can remove the buyer from the property and go sell it again. It's just that when you sell it again, you've got downtime on the property, meaning you have negative cash flow. And do you have to do repairs to the property? Do you have to clean the flooring? Do you have to do paint? Who knows? Things happen. And so I always like using the wraparound strategy versus the lease option for a lot of those reasons out there.
Well, and the thing is too, you're in the right state for it. I mean, it's the perfect state. Like what you said, if the situation goes bad, you can always foreclose and get the property back in as little as 43 days. So the one thing that I've always liked is definitely make sure you're talking to your local attorneys to find out what is your eviction process like? What is a foreclosure process like? And there's some circumstances where maybe it is something that you can resell with seller financing and then there's no more landlord duties. However, where we started, where we own most of our properties, where Scott does not like, which is upstate New York, and when we do a eviction on somebody in upstate New York, and we've had many that gave us $20,000, $30,000 down as a non-refundable option deposit, and then all of a sudden they do stop paying once in a while. But usually, if they get a little behind, they want to get caught back up. But we've had to go through evictions, and that takes in New York probably a good 5, 6 months.
Really?
Yeah. Versus probably 2 years with the foreclosure process. So once
You
again,
see, Joe, I would tell you point blank, in New York, the lease option strategy is the most favorable strategy over a lease option.
yeah, for sure. That's why we love to do that. But once again, and this is for everybody listening, we got many of us in many different states. Always check with your local regulations. Find out which one is, if the deal goes bad, here's the name of the game. It's how quick, what's the fastest way to get the property back? And that's always really important to know because every state is going to have some different rules to it. So what works in one state might be a little bit different. But
I'll give you an example here in Texas, Joe, in one of our houses. I bought a house sub 2 from a gentleman 5 years ago. Great deal. Good looking house. And he begged us to let him stay in it. And I don't ever do that. But in this case, I said, okay, I'll do it. And he paid really, really good for about 4 years. Then he started getting behind and no, good guy. But you get to a point where after 30, 60 days, we're moving pretty quick. It's like, okay, we need to go in, take the eviction. So we did so. Of course, we won in JP court. And here in Texas, we can be in court within 2 to 3 weeks. So very quickly. Then what does he do? He files an appeal with what's called a pauper's affidavit or an inability to pay the bond. Luckily, in Texas, you got to at least pay 1 month's rent into the court registry to do that if you want to stay in the house. And he did. Well, the problem in Dallas County is getting into the county court quickly. Now you're 2 months down the road. So now you're 3 months to get there. And it's a pain. Well, we get there, we're winning. We won the county court. And he says, guys, I can get caught up. I can do this. And he brings in like his payment's $2,500 a month. So he brings in $5,000. And it's like, okay, we'll give you another chance. And sometimes no good deed goes unpunished. So where are we today? Back in the same position. I meet the guy in the courtroom. We're talking. He's a nice fella. Mom had passed away. This happened, that happened. I got it. I said, look, we'll help you out. We can give you time to vacate. We don't need to move immediately. We'll do this, do that. What does the SB do? Goes and files another damn appeal. After he said he won't do it. Did it anyway. But this time, in Texas, not only do you have to pay money up front, you got to pay rent as it comes due into the court registry. He did not do that. So I've already filed my motion at the county court for a writ of possession, and I'm done this time. It's okay to be nice, but you take a fair but firm approach. And now I'm burning every bridge down there is. I'm done. You do that kind of stuff. I don't want to hear it anymore. No, I'll go set them out in the curbside. But all types of things like that happen. But as you said, and to your point, you better know what your court's rules and regulations are and how fast you can move and what you can do. And then cash for keys is so important. If you have a long time frame, like maybe New York, there's cash for keys a way to get them out faster because time is money and a lot. And sitting on a property while they're going through an eviction process for 5 or 6 months, like you guys might do in New York, oh my gosh, because every month you're writing a check to your lender. Every month. And one of the things I was just talking about this earlier on another podcast was if you're going to buy a home, let's say subject to the debt with a wraparound, we have an obligation to a seller. You better be able to carry your debt load and expect and anticipate these things to happen. And I see so many kids out there, and I say kids as opposed to people who are a little bit older and more mature, who they think they're going to buy the house, lease it out, or sell it in a day or two or a month, and oops, doesn't happen. and they can't carry the debt load. And so they go into arrears, they get behind, and now you're causing more problems for the seller along the way. And you're creating problems for our community when you do that also. So I'm a big advocate. If you're going to play this game, have the ability to carry your debt load, realize things happen. Sometimes there are bad things that happen. They could file bankruptcy on you. Oh my God, which happens. But no, again, as I said earlier, do you find anybody ever wants to be foreclosed on? No, but it happens. You can't prevent what we call the idiot factor out there. And does anybody ever want to file bankruptcy? No, but they do from time to time. But you just got to be prepared for it.
So one of the questions, speaking of, I'm glad you brought that topic up. This was a question we had before in the community. What happens if I buy a property from a seller and they have a mortgage and I buy it subject to, or I buy it with a wraparound and they go file bankruptcy later on, a year, 2 years, 3 years down the road?
Yeah.
What happens then?
So the best answer is who knows? But typically the answer is nothing. Now, if a seller was intentionally selling their home to hide an asset, meaning you've got a house that has $300,000 of equity and you sell it subject to your brother or somebody like that, the court can claw that back because that basically you're committing fraud on the bankruptcy estate in that scenario. And by the way, that does happen every once in a while in a blue moon. But normally, keep this in mind. A seller has sold their house. Yeah, they still got debt. They go file bankruptcy a year later, 2 years later, 3 years later. That loan is current with that lender. So they go file a Chapter 7, let's say, which is a liquidation. You own the property. They don't own it. So that property is no longer part of the bankruptcy estate. You're performing on it. The court's not going to claw it back in any format. The lender who is still in first lien position, you're still paying them. The great odds are nothing is going to happen. However, in bankruptcy court, anything can happen, and they're really the most powerful courts in the country. And just make sure you have a good bankruptcy attorney who understands these deals, that you maybe have educated a little bit in the jurisdiction that you live in, and have somebody you can go to answer along the way if things happen out there. I will tell you, we've had it happen many times to our own properties, and the answer is nothing happened. Things just went on down the line because banks really just want their money. They don't want to own the property. No, the asset is not part of the original seller's estate anymore. They're gone. And you're current making your payments. And so the great odds are nothing's going to happen. But can it happen? It can. What does that look like? Don't know. Every deal is going to be a little bit different. Just have a good go-to person to help you out when the time comes.
Right. And I agree. And Miranda's got a great question she brings up. What would happen if that guy called up the mortgage lender and told them that they changed titles? Can they call the loan due?
Can the lender call the loan due?
Correct.
Well, whenever a loan has been bought subject to or wrapped, they can automatically call the loan due. Sure, they can. The question is will they? And again, it's just understanding how the mortgage world works out there. If a bank forecloses on a property, they usually wind up losing a lot of money. Banks are in the business to lend money. They're not in the real estate business to own real estate, period. And if payments are coming in, et cetera, the great odds are it's not going to happen. But in this business, there is no 110% guarantee of any type whatsoever. It can. It's just one of the risk factors we have to deal with. And remember, you've got a power attorney for that original seller. And in all my days, Joe, I mean, since, gosh, going back to I hate to say the 90s. Were you guys even born in the 90s?
My kids call it the 1900s.
Thank you so much.
81.
I was in the 70s.
A whole 81.
Yeah, I know.
Thanks for making me feel a little bit older. I appreciate that.
Don't ask some of the people in the audience, though. Okay.
No. But you know, oh gosh, what was I going to say? I got off track there a little bit.
Going back to like the 1990s, as far as, the banks calling loans due or things like that.
It doesn't happen.
Yeah.
Even back then, they didn't do it. Even when, if you had a low rate loan, they could put money out at a higher rate. You didn't see it happen. Banks don't want it. I've dealt with due on sale now a total of 13 times. Total. Now, does that mean it didn't happen more? I just didn't know about it. But if I'm the closing attorney, they almost always come back to me to help them with the transaction if those kind of things happen, or if they have to foreclose on somebody, what might be, they call us. I get it. So 13 times, and 13 times we've been successful to get around it through some manipulation of paperwork and whatnot. It takes a little bit of effort. But does that mean the 14th time we're going to be successful? No. So all I can say is 10,000 closings or so in this business. 13 times I've dealt with due on sale, which shows it doesn't happen often, but it can happen. We have been successful to kind of get around it every time. We got the seller's POA to usually navigate a transaction properly. And realizing lenders just want their money, they don't want on that property. Can you find ways to manipulate the transaction? Yeah. And again, we've been successful 13 out of 13 times. It just doesn't mean that 14 is going to happen that way. So it's just proper disclosure between buyers and sellers. Do your deal the right way, take care of insurance right, make your payments, do all those kind of things. And I think you can greatly limit the risk factor of that happening.
And we dive into that all the time, guys. So this is why you're all here, is because you're taking your business serious. You want to make sure that you're closing it the correct way. Because like what Scott said, this is why I'm huge. And I've learned from Scott and Ron and some of the best. But if you do the closing the correct way, you get the insurance done the correct way. And then here's the most important thing is making sure that you're making the full payment on time every time, regardless if your renter paid you or not, doesn't matter. The bank still wants their money. That's the way to prevent any red flags from popping up at the lender to where your file or that file even lands on someone's desk. If closing's done the proper way, your insurance is done the proper way, and you're making the full payment every single month on time, if not slightly early, this is how you keep your nose clean. So,
Absolutely.
what does trigger most likely a due on sale clause?
I don't think I think there's a myriad of things that can do it. There's not any one thing that does. Insurance is probably number one, not being set up properly, because that's how an insurance company knows there's been a change. And guys, I tell everybody we close with, years and years ago, it was different as we were all kind of learning this new business. And by the way, subject to is nothing new. In fact, the name sub two didn't even exist prior to probably 2014, 2015. Back then, we called it a silent assumption because it was valid between buyer and seller, but not the lender. And in a sense, it was assumption, but it really wasn't an assumption.
Yep.
So this is nothing new along the way. Drafting insurance properly is important. I also don't like to talk to the mortgage company if I don't have to. I want to go online. I want to navigate everything online because you don't touch a real person. There's no notes being made or being put in their file somewhere along the way for someone to see. You go online and you change the mailing address appropriately. Great. Who knows? The computer. Today you've got to go in and change the phone number because I'm seeing dual authentication sometimes come through where you talk to somebody, they're going to text you something, so you make sure they're texting you that info, not to somebody else. Does the person you're talking to know that cell number they're calling is you and not the original seller? No, they don't. And so you get those kind of things handled up front, navigate it online, try to avoid using your power of attorney or your authorization form, and navigate things that way, and try to avoid people and having them make more notes online in some format. That's what I suggest whenever you can. And so I think navigating the online system better, creating your insurance can create a problem. And then, of course, the obvious one is just not making your payments, where you create a situation for them to do this. Now, there are some smaller lenders who may be portfolio lenders, and there aren't many. There's one over here in Fort Worth in the Texas marketplace. Whenever I see it, I stop. I automatically put it into a land trust, do some other things that are going to be done differently. And I navigated through that scenario, which I don't normally do, because I know that that's an issue. They're a small portfolio lender. If you are dealing with a small commercial bank, which is rare, but I just did one down in the Valley in Texas a few weeks ago, where a small local bank was the lender on a fourplex. We went through, created these trusts, yada, yada, sold the trust to the buyer. Same thing, only different, but the bank, all they know is it was put into a financial planning trust, they think. Okay, it wasn't. And they really wanted to dive deep into it. Could they figure it out? Sure, they could. But again, the bank just wants their money. They don't want to own that property and deal with the issues. And they still have their original seller on the hook with a personal guarantee. They're still in first lien position. So a little bit easier. But I think it's the issues are pay on time, get your insurance set up right the first time, navigate things through the online portals, and you can avoid that. And if you have an estate scenario here in Texas, our probate is so easy to work with. We can do what's called heirship affidavits. We send that heirship affidavit to the lender, so they will now share information with that particular heir, and then we work through that heir as opposed to the person who is deceased. Other states, not so easy. And you've got to figure out that probate process a little bit and get to the lender, the letters testamentary, as they probably call it, which is what empowers the executor, and let everything run through that executor to you and just handle some things in that format. So it takes a little bit more work when you have that. But I always stress to a seller, to investors, don't call a lender and tell them somebody passed away. The lender doesn't care. They don't know. They don't have any right to know that someone passed away. All they want to get is their money, right? And I find out that so many heirs, they'll call the mortgage company. Oh, my mom died. My dad died. Why? Just make the payment. They don't care. It doesn't change anything. They can't foreclose on a property just because someone passed away. But so many people think you have to do that. I think the only thing that we as an investor need to do is contact the taxing authority, especially here in Texas, where our taxes are 3 times higher than, all of you guys deal with out there, I think, along the way. Joe, are your taxes pretty cheap in Florida?
They are, but the houses are expensive, so it's almost a wash. But meanwhile, from upstate New York, it's insanity how high taxes are there, but our insurance is 1,500 a year. Meanwhile, insurance in Florida could be 5 to 10,000 a year.
Oh my gosh.
So if they get you one way, they'll get you both ways too.
It seems that's the case. So, yes, but learning how when you get insurance, for instance, I just bought a house in Fort Worth sub 2. Great deal, 2.85 interest rate, home run. Great house, needed 0 done to it. Actually, with a little bit of equity. The guy that lived there got transferred in the military to Arizona, had to move, didn't have an option. Too long to sell the house. We stepped in, took it over. He made a little bit of money, not a lot. Great deal. Because I'm selling that house with a wraparound on the back, I'm not going to lease it. I'm not getting a new insurance policy. I just added us on as a party of interest. Very simple. I've got the seller's POA. I've already gone online and changed everything. So if there's an issue or a problem, everything comes to me today. Because I am going to sell this to a back-end buyer with a wraparound mortgage. And at that time, we will get a new insurance policy where the home buyer and the seller are both listed as co-insureds on that insurance policy. Great. At that point, we'll do that. The mortgage company is going to be listed as the primary loss payee, and we'll be listed as a secondary loss payee. And the mortgage company is going to look to see that their borrower is listed as the insured on that policy. And then they will make sure that they are listed as the primary loss payee. Those are the two main things that they're going to look for every time. If you don't do it, they kick it out. Red flag goes up. What's going on? What's happening here? Don't give them a reason to do that.
Right. And that's why it's important to make sure that we've talked about this before, making sure your insurance is set up the right way. Donnie's got a few questions for you. You want to?
Well, he had a few more earlier too.
So what
It's
is
all this free legal advice he looks for?
So what's the difference between a mirror wrap and a regular wrap?
Okay, so first off, a mirror wrap is used normally when we're buying a home from a seller who doesn't want to let your mortgage go for the length of the term of that loan. 28 years, 25 years, 20 years. Maybe they want a shorter term, 3 years, 5 years, 7 years, 10 years, 15, whatever it might be, whatever you can negotiate. It's simply to give them an option that they know that their loan is going to get paid off one way or the other in a shorter time frame. And by the term mirror wrap, what that simply means is that we are mirroring the terms of that mortgage. And by that means if it has a 4% interest rate, if the payment is X and the number of years are Y, the terms of the wrap loan are identical to that. Normally with a wraparound mortgage, what that implies, besides wrapping around the existing debt, a mirror wrap does the same thing. A traditional wrap mortgage is usually for a greater dollar amount than the underlying debt. It is for a higher interest rate and a greater payment. Maybe the loan you bought subject to, for instance, has a 3% interest rate on it, and you're going to sell it for an 8 or a 9% rate on the back end. Great. That's your traditional wrap loan versus the mirror loan. But the mirror wrap is used normally to replace a sub-2 transaction because the seller is looking for a shorter term versus a longer term. And if I'm selling a house to a back-end buyer, I really don't want to do a mirror wrap. I could on certain deals if I'm looking to get a bigger down payment. If I'm asking for a $20,000 down payment from a buyer, let's say, or a $30,000 down payment, and I've got equity, they come in and they have $100,000 to put down. And they can come in and take over a 3% loan on that property. Am I going to think about that? Yeah. Now that doesn't happen too often, okay? That's not even once in a blue moon. But stranger things will happen from time to time where you do find people have substantial down payments. And maybe at that time, you want that bigger down payment like that versus the smaller one. Okay, I might do a mirror wrap from seller to me and from me to the buyer. Maybe I bought it sub-2 and I do a mirror wrap to the buyer. Why would I do a mirror wrap to the buyer? A, I capture that huge down payment maybe. There's some reason for it. But B, I want to stay in the middle of the deal. Why do I want to stay in the middle of the deal? Because what if something happens to our buyer downstream? They default 3 years down the road, 5 years down the road, 8 years, whatever it might be down the road. Well, if I'm tracking this thing a little bit, could I foreclose on that buyer? Yep. Could I get the house back? Yep. My loan balance has gone way down. Value hopefully has gone up a little bit. Home run. So all types of things like that can happen. There's a rhyme and a reason for everything out there. And the key is just understanding your deal. And I always like to tell investors, because we are investors, stay in the middle if you can. If your back-end buyer is a homeowner, guys, those homeowners have no idea how to navigate these deals. The realtors they deal with have no idea how to navigate these deals. And so being in the middle helps you navigate things a little bit if needed. But in real life, the situation I just described happens all the time. Many, many times for us in instances, those kind of things happen. And having the ability to step in and either navigate it to help out the parties or take the deal over. Maybe I can negotiate a buyback from that buyer down the stream somewhere along the way. That becomes very advantageous to us for those instances.
So, and I want to bring something up right now because some of you might be sitting here like, oh my gosh, this is gold. This is amazing. Some of you might be scratching your head like, whoa. Okay. And you probably are going to have a mix of that going on. And that's totally okay. Here's where I'm going with this. Before we hopped in this call, Scott just gave me some really cool information that his title company could close in all 50 states, which I did not know that before this call.
So our title company is called First Option Title, Joe. That's
Mhm.
in Texas and in Arizona. We're licensed title operators in those two states. Our national company is called OFN, which stands for the Owner Finance Network. So OFN National Escrow Services. That's headquartered also in Scottsdale, and it covers the state. So I just wanted to stop you there for a moment because there is a little differentiation. Proceed.
Okay. The point of what I'm bringing up here is that if this is going over your head, you can bring, if I'm not mistaken, some of this education, you could help out in other states.
Absolutely.
So if you're closing a deal in other places and you're like, wow, does my attorney get this? Does my title company understand this? That doesn't have to be your only option. And odds are, Scott's going to probably agree, most of them don't know. And they definitely don't know how, if they say they do, they probably don't know how to do it correctly. I've witnessed that more times than I could even imagine.
And Joe, we birthed OFN National Escrow for that exact reason. I was getting so many calls from so many investors and TCs. They're going, who do you recommend closing in XYZ state? Because no one here knows how to do it, or they won't do it, or they don't understand it. And so it was just an opportunity because this is all we do.
Mhm.
You know, my little law firm here in Texas, you know, I might be a lawyer, but I'm really the investor, the asset-based lender, et cetera, who understands our creative finance world really well. And our title offices are pretty much 100% investor-based, whether it's Dallas, San Antonio, Scottsdale, whatever it might be, because that's all we deal with are investors and all these funky deals that have hair on them. Then you go into the creative finance world, and there are title companies who want to try to play the game, but who are they going to get to draft the paperwork?
Right.
So sometimes you can find a lawyer who knows how to draft a wrap loan, but how do you draft a subject to deal properly to protect the, and we have a national document drafting firm that we have kind of trained to draft our paperwork for us, no matter what state it's in, to understand how to do this and to be compliant for that state. But it's important just to understand that there is that out there, but it was created for that very reason that they ain't got a clue, or they just don't want to do it. They just walk away.
So a lot of my questions are for you guys listening. I see there's a couple of questions in the chat, but what I'm going with this is you don't have to figure this out on your own. Obviously, you got us, but you got backup coming in. And I gotta say, Donnie gave you a shout out on one of our support calls the other day because he's like, Scott called my seller. Scott explained to the seller what's going on. So there was full transparency, understanding, got the deal structured even better, right? Because now he could buy it with a wrap and then instead of doing title or contract for deed, explaining to the seller why this is actually a good move, the right way, walking her through it. So it was a tremendous helpful for just Donnie. So if you're in another state and you've got things going on, I know Mike Collins, he's just a little bit farther north of you up in Oklahoma. There's, I got the Coles, they're in New York, but they just dropped a really interesting question because they do have a New York property that they're selling a duplex on a wrap. It will be the buyer's primary residence with the insurance changing from our landlord policy to a primary policy trigger anything?
Probably not, because mortgage companies don't necessarily look at that. They don't care about that. What does a mortgage company care about? That their borrower is listed as an insured. And number two is that they're listed as the primary loss payee for the proper dollar amounts. Those are the two things that their $15 an hour person looks at when the insurance policy comes in. This doesn't go to some senior level management who's going to analyze this insurance policy to the nth degree and go, oh, look at this, what's going on here? No. These guys get thousands of policy changes every month, I'm sure. Maybe tens of thousands of changes every month. They're going through, going dollar amount, property address, who's the insured, who's the primary insured on there. And if all those match up, great, scan it, file it, move on to the next one. That's what they do. So they don't get guys like us who are thinking this way at all. They're there to do a simple job, handle the insurance, make sure the right things are in the right place, move to the next policy and go.
Bam. Next question we had, what is the difference in the transaction between a VA, FHA, and a conventional loan when buying subject to or with a rep?
So first off, zero. So let me back up. You can purchase a home subject to or wrap any kind of loan you want to in the marketplace, period. That's the first thing to understand. There are no rules or regulations that say you can't do it. Number two, back in 1990 or 91, there was a singular lawsuit that, where there was some issue with an FHA loan that was done, which is why you will hear title companies don't want to get involved with providing title insurance for FHA or VA loans. Hang on 1 minute, guys. It's 7 o'clock here and my last gal is leaving. That's awesome.
Mm.
But it was only one deal. We are able to issue title, at least for FHA and VA transactions in Texas and Arizona. Not so much in other states just yet. However, through certain title operations, we are able to do that. We can always ask that permission if we can get title insurance, if you're buying sub two and you want title insurance. If for some reason we are unable to provide that title insurance because of that in the state where you're buying a property, obviously we're always going to pull an abstract and review and verify and validate things the best we can on those deals out there. But there's been this huge, just in the last probably 18 months, all of a sudden it's like, oh my gosh, we're not going to do a wraparound loan on any VA loan or FHA loan at all, period. And it's like, where did that come from? Out of left field, man. Not left field parking lot. It is like, yeah, no. And it's just people who are fear mongering a little bit. Somebody hears something, all of a sudden it spreads across the internet, and all of a sudden it becomes gospel. Yeah, no. So, no issues in buying a property sub two if it's FHA, VA. The only thing I will say is on a home equity loan that you will see somewhere, you do not buy a open-ended home equity loan. It must be closed and amortized, period. I can just see that seller going out and borrowing more money against their loan on a house you just bought. Yeah, no. So you make darn certain that deal is closed, fully amortized before you do anything in that regard.
Yep. And if you have more questions about that, we definitely dive deep into that because you don't want that lingering open check account basically where they could go borrow against it more. There's usually something they sign, but then they still go ahead and take that money because people do people things. We got that one about how to do the insurance the right way. Can you explain the difference between a deed of trust and a warranty deed?
Okay, guys. So with a traditional sale, you have 3 basic documents. You have a warranty deed. It could be a general warranty deed. It could be a special warranty deed. You might see a cash warranty deed on a rare occasion. But a warranty deed is what conveys the ownership of the property. People will call it a deed. I see people call a deed of trust a deed. It's like, stop. So you have a deed to the property is what conveys ownership. A general warranty deed means you are warranting title back to the inception of the earth. A special warranty deed means you are conveying title for the time you've owned it, 3 years ago to the day, that title is clear. You're not warranting title going backwards beyond that. Normally, when you get title insurance coupled with a special warranty deed, it acts like a general warranty deed because now you are insured that title is being warranted going all the way back. A deed of trust is the document that a lender will take as security for their property. Some states may call it different. You might be in a mortgage state. There's a few out there to do that. And a mortgage state is where they combine more or less a note and a deed of trust together. That's what I'm looking at. But the deed of trust creates the lien on the property, which is the security for the lender to secure their promissory note that you signed. Here in Texas, we call it a real estate lien note because it's a note that has a lien against it on a property. So you have a deed of trust. That's what gives that lender protection and gives them the right to foreclose on your property under that deed of trust. You do not foreclose under a deed, a warranty deed or a special warranty deed. Now, you might see a document called a general warranty deed with vendor's lien. Well, a vendor is usually the seller, and the seller is not carrying a lien back. It's just the terminology. And the vendor's lien simply means that there is a mortgage on the property. And for instance, here in Texas, and forgive me for using Texas, but I don't know what the rules and regulations are in other states per se. You know, I can foreclose through what's called a non-judicial foreclosure in Texas, meaning I can foreclose without any court action at all. It's sending out a 20-day notice to cure a default. If it's a consumer, meaning an owner occupant, then I can accelerate the loan if they don't cure that default. And I can post it for foreclosure in as little as 21 days before the first Tuesday of the month. I can move quickly. But if for some reason there's a defect in that deed of trust, where I don't have that deed of trust, but I have a vendor's lien in the deed, that allows me to do a judicial foreclosure under that vendor's lien. So one of the things you want to determine is what type of a state are you in? Deed of trust state, mortgage state. What are the foreclosure rules and regulations in that state? And again, it's accumulating all this info. And guys, I don't know how many of y'all are new or how many of y'all have been around for a long time, but you got to be good at gathering information like this and compartmentalize it and learn it. Know the little details. You don't need to be a pro at it, but you need to understand the basic workings to be proficient. Otherwise, sometimes you might learn the hard way. You don't want to do that.
Mm-hmm. So many times too, if you aren't super deep down the rabbit hole, bringing somebody like Scott on who is to overlook to make sure everything is done the correct way. And like what you said earlier, Scott, I love it too, because they come back to you if there was a problem, right? The bank's calling or something like that. So to make sure that you're having that done is the most important thing at all.
So Joe, did you just call me the rabbit or the hole?
Both.
Oh, okay.
Both. I think you'd qualify for both because, as long as you do this business, you do it enough times and you start seeing the same questions pop up. Once in a while, you get something thrown at you from left field that you're just like, whoa. But majority of the time, it's just by repetition. So it's being a student of the game and what we're doing. I see we have, if you wrap a wrap in Texas, are all three parties on the insurance?
No. So the answer is maybe. So a wrap of a wrap. So let's assume for a moment that we as the investor buy a house subject to the debt. We've already talked about the insurance of that a little bit. I know, Joe, you all do that quite a bit in your training. So you buy it sub to and you wrap it to maybe another investor. Okay, great. However you do that, well, at that point, you do traditional insurance for that investor. Maybe he's deciding to use it as a rental property or an Airbnb, something initially. Maybe he's going to move in and live in that property. Who knows? But then something changes and he decides to sell it to another party. Maybe that person is a consumer, being an owner occupant. Fine. So he wraps his wrap. So who's on the insurance? Well, the original seller because I'm putting my arms out here, you can't see. The original seller is on that insurance, obviously, and the back end buyer is on that insurance as co-insureds or additional insured or whatever you can get. Number one. Number two, the lender, whoever that lender is, that original sub two lender out there, is the primary loss payee. And if I'm selling the house, let's say to Jennifer on the back end, I would be, or my company would be, the secondary loss payee in that scenario. So again, it's just taking a little bit of time, slow down, navigate it, chart it out. It's easy to do, but it's protecting everybody along the way.
I love that. And so when you were talking about this earlier too, that if I sell a property with seller financing, like a wrap, because I bought it subject to, or with seller financing and I sell it to, I see Oscar's smiling face. So I'm just going to say Oscar's name. Oscar buys the property from me on a wraparound mortgage, right? So I bought it seller financing or subject to or a wrap, and I'm going to re-wrap this to Oscar because he's smiling and I love that. And now the taxes go up in the property. When you're doing this, how do you convey those taxes over to Oscar, who's the end buyer, so he's paying that?
Well, it's keeping in mind who has the responsibilities and obligations. Obviously, the mortgage company will get notice of the tax increase and they'll increase their taxes on their mortgage statement, which is why it's so important to make sure you change the addresses through the online portal so that you get your proper mortgage statement to know what you pay when that happens. So that's number one. Number two, as the middle investor, so I'm Joe, who sold to Oscar. So Joe, it's your responsibility to understand, to track that escrow. Because technically speaking, Oscar pays you and you pay the mortgage company, right? And even if Oscar was out there and Oscar was paying Donnie, Oscar and you both had a responsibility. You would give Oscar that increase in payment, and Oscar does the same thing to Donnie, where you do a change of escrow payment. Taxes have changed. Now, in this business, you have to stay on top of this. Now, normally, if we're doing a wraparound loan, we are going to incorporate a third-party loan servicer into the equation, who is our fraud preventer in this industry. We want that servicer is going to help with that. But at the same token, just because a servicer is out there, guys, servicers are not the end all of end all for you. They are there to do one thing: collective payment and distributed payment. They're not there to be your collector of your payment. They're not there to be the navigator for all your escrow stuff. This is your loan. This is your debt. Take responsibility for it. Stay on top of it and do things the right way. Too many investors trust the servicer to do everything. They think that servicer is going to be their collector. Yeah, no. What do? They send out a notice. What does that notice do when the homeowner gets it? Round file. You know, they might make a phone call a month to collect that payment. And what happens in my world is 4 months later, 5 months later, I get the phone call. Oh my gosh, my borrower is 4 months behind in payments. What do I do? And it's like, okay, well, we can start the foreclosure process, but now you're going to be 6 or 7 months behind in payments before we get the house back. And if you're in another jurisdiction, it may be longer. Be proactive. Stay on top of things. And too many investors want to treat this as mailbox money, and they don't want to do any work at all. No, this is your money, and who is the best person to protect and navigate your money?
Your wife.
Do you trust her that much?
Oh my gosh.
Do you think he knows how to log into a portal?
But you know,
you
bring up a great point too, because I mean, you're telling me, Scott, that real estate investing isn't passive. I saw that on a podcast one time.
Oh, imagine that.
I don't know.
My 35 years of doing this, it has never been. I go out and knock on doors to collect payments. I went out Saturday afternoon here in Dallas. So Guys, I love investing creatively in my IRA. Man, y'all need to learn how to do that. Oh my gosh. You get to a certain point in time, an economy of scale, things can explode on you. I mean, explode. Listen to them.
To me, it's monopoly money right now. But yes,
he's like, we can't touch it, so it's monopoly money. I'm like, I know, but
It's amazing what the tax-free money can do for you.
Okay.
But this gentleman, we're very, very, very proactive in my office. Payments are due on the 1st. They're late on the 10th. We're making phone calls on the 11th or the 15th, maybe the 20th. And on about the 20th or 21st of the month, we're sending out our initial foreclosure letter. We stay on top of it. And in this one case, they were 2 months behind, and what we call accelerated the loan, meaning we're now going into foreclosure mode. We've been trying to call the borrower, not getting return phone calls, not getting anything. I go knock on the door. Do you think I find the homeowner there? No, I find a tenant there. And of course, in this case, the tenant speaks only Spanish. All of them speak only, and me no habla, guys. I am white bread. Let me just tell y'all. I have a hard enough time just saying, donde los baños, in that regard. But
Bathroom.
found out what was going on, got them to come into the office. Yeah, good people, all that kind of stuff. Then I find out that they've been talking to the wife, not to the husband. And what's going on? Yeah, they're separated. I've been going down the rabbit hole. They're not going to cure this. So I'm proactive. I didn't send out, I had them sign the appropriate notice to protect me for the October payment. And I'll take care of things down the road very quickly. But it's being willing to do that. And most investors want to send them a button and go, I'm going to let somebody else do that for me. I have recognized and have learned long, long ago, this is my livelihood. This is my job. This is my career. And I am that guy who can go lay on the beach and kick his feet up and do whatever the hell I want to do. I just love the heck out of this business. It's fun. I don't mind knocking on the door. That's the right thing to do. And I'm not there to take the house back. I'm there to really try to if there's an issue, how can I help you through this issue? Let's communicate. But, and sometimes you force that issue and sometimes they won't talk to you. Okay. See you at the courthouse steps or whatever it might be. But do that. And so many people, Joe, as you just said, I think they're lazy. That's just everybody wants somebody else to do the work for them. So what we not do it, but you realize it's your money. It's what puts food on your table. It's what pays your bills, everything else. Go make it happen. I have no objection to doing that.
Right. And that's why this group here, they're all the same way. These are a bunch of go-getters. They're not worried about rolling up their sleeves. They just, and that's what I think is super important because there's been times I've knocked on doors and said, where's the rent? There's been times where there's problems going on and I had to leave my job back when I had a full-time job. And like, oh, boss, the house is on fire. I got to leave. And that's happened to me. So as these things come up, you got to really own the position, own your business and be a business owner. And unfortunately, sometimes you hear some sad stories, but it's a business and we have to treat it as such because if not, it's coming out of your pocket.
And I just love that you're here because again, it's like, don't be scared of any of this, right? I think some people get nervous about like the bad things that can happen because they could and they may and they most likely will if you're in it long enough. Like he just said, we had a house fire. But it's
flooded.
Who can you have in your network that's going to help you through those challenges? And so I think like it's a breath of fresh air. I even love hearing the reminders, that we're in it to help people, but also it takes work. Yeah, absolutely.
Yeah. Luckily Texas is an open carry state. So yeah, I carry. I'm not, that doesn't bother me at all. But, I've never had in all of my 35 years, and I bet you I have walked between 25 and 30,000 houses in my day. It used to be that you could buy here in Texas back in the late 80s, early 90s, you'd buy one out of every 3 houses you looked at. Jeez. I missed those days. That number slowly grew. Today, we're about 1 out of 12, 1 out of 13. And the average, at least in Texas, is about 1 out of 25. So you got to see 25 houses to buy one. that may be true across the board. I don't know, but it's an effort, right? But in all those days and all these things, I mean, I know where the not so good parts of town are, and I actually did a rehab. I was younger, maybe 28 years old, on a house in what I would call the hood of the hoods of Dallas. But when you're polite and you meet the people and you talk to them, you help them out, your neighbors, what it might be, for the most part, they're okay. For the most part, not always. There are some parts of town, I won't go into unless it's 10 o'clock on Saturday morning. And if it's after 3 o'clock, yeah, I ain't going there. You just want to be smart. There's some things I want my partner, Susan, go, period, without me or somebody else there with them. Just not going to happen. But it's okay to do it and just be smart. I've only been scared twice in my entire career. And when the hair on the back of your neck stands up, get the hell out of Dodge, come back the next day.
Mhm.
It's okay. Just don't put yourself in a bad position somewhere. But you know what? If you're nice to people, you treat them fair, for the most part, it's okay.
And that's spot on too. I mean, my dad was a landlord and we had some really tough neighborhoods that I grew up going to, and everybody was cool with him. Everybody's cool with me because, I was his son. But man, some of the people the stuff that was going on in that neighborhood, but they were just great people once you got to know them and they got to know you were there often. But you just gotta, and Florida turns into an open carry in 2 more days.
Does it
Um,
really?
yeah, now you can do both.
Love
So
that you know that.
25th, it's a thing here. Um, Question, what service company do you recommend? Now, there's certain service companies that just do certain states. The Coles are in New York. I don't know if you have one in New York.
Well, we work, so our partner, his name is Sohail,
Yep. He's
and
awesome.
it's Provident Loan Servicing. And I love him because, although, by the way, I don't care who you deal with in servicing, I don't care who it is, get ready. They're going to get their panties in a wad somewhere along the way. There's a lot of little nitpicky things because investors call them, because investors don't understand the business, what to do, how to do things. They think that the servicer is supposed to do everything in the world for them. That's not the case. And I get that. As a lawyer, guys, and as a closing person, I got to teach my entire staff. It's like, guys, talk to them on the phone with a smile, be nice, be polite, hang the phone up, then have a primal scream. I get it. We've been there, we've done it, you deal with it. It's just life, it's human nature. Fine. We deal with 100 deals at a time. Sometimes the investors dealing with one. And in the servicing world, it's the same thing. They have a lot of deals going on. You're just someone else. They're there to help you out. But I like Provident because Sohail is a guy who is um, 26, 28 years with Fannie Mae. He knows the business and understands it. I love talking to him. It's kind of like having this call with you guys because we can sit there and talk, and we can talk about this, that, you name the issues, whether it's the RAP rules and regulations, whether it's RMLO, whatever it might be. He gets it, I get it. It's fun. It's hard to find that. Everybody has a little piece of it. They don't have the whole piece. And I see he has the whole piece. So I like him, number one. You know, um, in Arizona, there's a company called Westar. I don't know a lot about them, but a lot of investors tend to use them. I find a lot of smaller people out there. There's one in San Antonio who may be okay. Um, there was a group here in Dallas, August REI, but they're kind of, in my personal opinion, they're going downhill a little bit. They're losing a lot of business because they're just not paying attention. Don't know what's going on there per se. But if you're going to pick one out, I would say obviously I'm going to promote Provident because we're partners with him. We handle all his stuff. If there's any issues along the way, but it doesn't mean you have to use them by any means. Interview your people, make sure that, because for instance, with Provident, this is all they do. They don't do anything else. There are some companies who want to blend traditional mortgages with owner finance mortgages. Guys, that's apples and oranges. You don't want that. Find someone who deals in this world only and gets what's going on. Ask the questions, interview them. If they don't, go find someone else.
Boom.
Got it. We'll make sure we drop his information with you guys too. So Scott, you've obviously been a wealth of information. Any last words of encouragement or something? We've got different levels of investors here. So some are just starting out. Some old dogs have been doing this for a little while, but words of wisdom.
Why does everybody ask me these things at the last of the interview? I'm not prepared for any of it.
Well, then they
I mean, you already dropped so many nuggets, so much gold, but if you were to
whatever.
one final thought.
No, I just think I don't care who you are in this business. Realize we have a changing world around us, obviously, right? We have changing politics, we have changing economics, and it affects everything. You know, it affects our buying of properties, it affects our selling of properties. You've got to keep your pulse on all of these things. You do not need to be an expert in everything that we do, but you do need to have a modicum of knowledge base in a lot of little things. You need to understand what the rules and regulations are in your state for evictions, for a foreclosure. Are you in a state where there might be foreclosure rescue laws? Ask the knowledgeable real estate attorney some basic things. Do your homework about this. Get that knowledge base. Understand how a subject to deals works and the things we talked about today. Understand how a wraparound mortgage works. Understand how you do that. Locate and find the good people like a good loan servicer along the way. If you're going to do a wraparound mortgage, guys, understand in Texas, there's a free property de minimis rule, but we suggest you process a buyer every time. And in every other state in the union, if you're doing a wrap loan, you must process the borrower every time, first time, last time. There is no exemption. And I talk to people who are experts in this field and they have no idea what I just said. We'll come back and visit on that in a minute, Joe. But getting just the peripheral down. No, what is the SAFE Act? What is Dodd Frank? What does that mean? How does that affect our business, buying or selling? You don't have to be an expert, but you need to have a little bit of knowledge of a lot of things. What's title insurance? What's an abstract of title? Is there a difference? What's the difference? What's the cost? Do I need title insurance? Do I not need title insurance? What's the risk? We're all different risk averse. But gathering that modicum of knowledge and then get off your butt and pull the trigger and go do something. You know, stop being so flippin' risk averse, you know, in that regard. I wish I could tell you guys how in the world I got this business because I wanted to eat. I think at the end of the day, what's going to work? I mean, everybody thinks I have some great magic pill, how you go from here to here. No, just get out, went and did it. It was fearless. Maybe it was stupidity. Hell, I don't know anymore. But it was never being scared to go do it and then being creative and finding different ways to navigate and create opportunities. And learning how to do that can drive you in this business. But sitting back and doing nothing and being a gatherer doesn't work. Get off your butt, go out and do it. Don't be scared of talking to people. Find private capital. Learn how to work with private capital, which is so important today in our world. And the last thing I'll say, because that was not a short little nugget, is I cannot imagine anything else doing in my world. This is so much fun. I get a chance to do a lot of things. I get it. I'm really an investor and a rehabber at heart. That is my number one thing. It's awful nice to have a law degree and title company and having learned to do those kind of things. But the real estate investor side is what truly drives me in this business. It is fun. It's work, but I can't imagine going out and doing anything else. And guys, if you got a day job, don't quit just yet. You know, everybody goes, oh, I want to be like Scott, I want to do 20 deals a month. Yeah, maybe you're not cut out to do that. Maybe you're cut out to just be an investor who does a deal a year or 2 deals a year or 3 deals a year. And that's fine. You can do awesome in this business just doing things like that. So listen to your people over here, your trainers. I think Jen's really the brains. Not sure about Joe per se. We'll see how that goes. But
Absolutely is.
you know, getting that down, having someone you can talk to and learn. I didn't have that advantage. They didn't have this little great thing here called the internet when I got started. You know, so I had to do it the hard way. So you get a little bit easier way, and when you can do that, it really helps you avoid the pitfalls, because there are pitfalls in this business.
Well, I feel like he's looking in the mirror because I know he just loves it, and I don't think he'll ever quit investing.
Well, I get asked, well, when are you going to retire? It's like, what?
Yeah.
That word is not in the vocabulary. You know, I will work till I'm 120. It's just, it's okay to work. I might slow down a little bit, but I have no trouble with working, and I hope everybody thinks that same way.
I absolutely love what I do. It's my business, it's my hobby, it's what I
Oh,
love to do.
amen. I
Yeah.
collect houses for my hobby.
Yeah.
You
Well,
know,
and I say I get to talk to you. I get to talk to these my friends here about real estate, and I feel like I'm the luckiest guy on the earth. I don't have a job where I'm working 12, 15 hours working at a car dealership like I used to for 20 years of doing it. Now that I get to do this full time and do it ourselves and close deals, and it's the greatest thing in helping other people, I don't know, I feel lucky I get to do this.
Joe, first off, I didn't know you were a car dealer. Were you a used car dealer?
We were the biggest Chevy dealership in the country, so mostly new. I was in the finance office.
Literally checked my credit like 2 weeks in dating. He's like, I need to pull your credit.
I knew she was worth
Can you
marrying.
blame them? Come on.
Hey, I could tell you, I've seen some things, so I always check people's credit. But that was what my job was. So, but you got to work a lot, and it took me 20 years of investing on the side, like what Scott mentioned, doing deals while I still had my job in order to get me out of it and to get me to do this full time. It wasn't like 6 months in, I quit.
No, I mean, I did the same thing too, Joe. I mean, when I decided to quit commercial real estate because nothing was happening in the recession, and I was just trying to figure out how to do something somewhere. You go, I'm done. Let's go start your law practice. And of course, again, that's the blind leading the blind there too. I had no idea. I didn't have the privilege of working for a law firm, being taught how to do things. But you go out and you start driving business in whatever that might be, right? And then we started the slowly of buying houses. One house. One house was two. Two houses were four. Four was eight. Eight went to 30 or 40, then boom. But I had that daytime, I say daytime, I was working 16 hours a day because I had to bring in income to maintain the real estate habit until you can get that economy of scale going sufficiently where you can slowly start to cut down on one and replace it with the other.
Mhm.
And you don't want people to go out and quit their job and go, I'm going to do this full time. That's hard to do. When you're young, when you're 24 years old, you can do a lot of things more different than you can when you're 50 or 60 years old. But it doesn't mean you can't start investing today.
So.
Spot on. And that is the truth. Jen got to walk away from teaching long before I did. Because that was the goal. Once we got married and had kids, she was gonna be the stay-at-home mom and stop teaching. Plus teachers, like they work hard, but they didn't pay her a ton. So that was the first job. And then the goal was to bring me home, but it took some time of investing and keep buying deals. And we learned how to do creative finance, so I didn't have to have a W-2 anymore. So when we started, I didn't even know, Scott, this world existed until 2015, creative finance. I did my first deal in 2000, 25 years ago. But 15 years later, when I was like, wait a minute, I don't have to go to the banks anymore. I could just take over paying someone's mortgage on their behalf. Like it blew my mind. So,
But you know what? I had this unique experience. If I said the name D'Angelo, do you know who that is by any chance? Ken D'Angelo?
no.
You ever see the signs, we buy ugly houses?
Oh, yeah.
So he started Home Investors
Okay.
from Dallas here.
Wow.
So when I was 20, I don't know, 27 years old, probably, we were getting into this business. It was a brand new business. Again, no internet. You don't have any of this stuff. I mean, you do things through newspapers, magazines, phone calls, meeting people, signs, whatever it might be. And here we were flipping houses. We met Ken. He was in the jewelry business. He even brought a riverboat up from Waco to Dallas to Lake Ray Hubbard to make it a little restaurant. He and a partner did just try different things. And eventually we were selling houses back and forth to each other, not knowing what we were doing, trying to figure things out. You'd go to lunch. This other guy, Craig Pettit, came in, who was the very first hard money lender in Texas. And he worked at Texas Instruments. He was a computer nerd. And he did a loan here and then a loan there. He got more people from TI to give him money to lend back out to. But we'd sit down and start just chit-chatting. What about this? What about that? Could you do something a little different here? Could you do this here? Well, what do you do about this issue or that issue? How do you find more deals? How do you find better buyers? And you start collaborating, right? And you get this roundtable going. And one day, just for instance, with Ken, he said, we got to find a better way to generate this. We're going to start doing a billboard. I'm going, how much does a billboard cost? I mean, that was crazy money back in those days, what it cost to get that. But you got a lot of feedback. And one thing led to the next. And then, he eventually started Homevestors and had one franchisee, then two, and then whatnot. But things like that is how you learn this business, getting in with the right people. Was I a mover and a shaker per se back in those days? Hell no. I was some snotty-nosed little kid, just trying to figure out life and what you do. And thank goodness I was single at that point in time. And you have the ability to do that. Whereas if you're married and have kids or anything else, different ball game. You got a different role at that point in time. That's when you got to whip your wife with a rubber hose, make her work harder so you can talk. I'm kidding.
I don't know what world you're living in.
Getting beat up.
Do not let me tell that to my wife, because I'd get whacked.
He says
But
that.
anyway, it is just that. And it's learning those kind of things as an investor that it's not the easiest thing in the world to do. That I did have, just like you, those two jobs. And you're trying, and are you willing to put that time and effort in sometimes to do that? But I'll walk away with one last thing here, that there's one of the big teachers here in DFW years, and his philosophy was, guys, you don't have to go out and do 20 deals a year or 30. You can, and this was way before even sub 2. But if you buy one house a year, even at full market value, and you go to a bank and you borrow money, you put 20% down, let's say, to get a loan at that bank, and you learn how to sell the back end with creative finance, with a wraparound mortgage. So maybe you get a bank loan today at 7.5%, and you sell it back out at 9%, 9.5%. But you take all the income from your back end buyer. You take the down payment and you replenish the money you're out of pocket. You take the income and you apply it to your debt to accelerate it. Okay, great. Well, a year or two, you go do it again, right? Same thing. But now you take the income from house 2 and you apply it to house 1. Year 3, the same thing. Apply the house 1. Well, eventually, you're going to pay house 1 off really quick, right? Pretty simple math. Well, when that pays off, you take all that income and you apply it to house number 2 as you're going through the loop. You do that for 10 years. You have 10 houses after 10 years, or 10 mortgages you're holding. But now you're hyper accelerating through proper financial management. If you do it that way, where you don't live on that money, you don't put it in your pocket all the time, you have that day job. In about 13 years, it used to be about 12 years, maybe it's 13 or 14 years now, this with interest rates changing a little bit, you can have 10 mortgages debt-free. So if those mortgages were originally, let's say, $200,000 mortgages, after 10 years, okay, do you have 20 million? No, you probably have what, 17 million or 1.7 million of mortgages debt-free that are paying you something around 15, 16, 17,000 a month in debt-free income for the next 15 years. That is where everybody wants to be. And it's just about how do you get there and how do you keep yourself organized to do that. And too many kids today, they won't do that because they want money right now, instant gratification. And real estate investing is called that because it is not real estate, job, more or less. And it's helping, just if people will learn how to do that, whether you got a full-time job, you can still do very, very well learning proper management control of financing.
So you could see, guys, why we brought Scott on here.
I don't even
35,
know what to say after that.
35 years of wisdom, tens of thousands of deals closed, right? 30, 40,000 houses walked. You could see why this is why these are the absolute best. And I just want to thank you once again, Scott. We could sit here all night long.
We could.
And I don't ever want you to go, but you've got stuff going on. And some of our followers do too here, people in here. But I'm going to be able to, I'll get from Susan your contact information, just your home address and cell phone number for everybody. No, I'm kidding.
That's fine.
But I'll get your contact information from your office. So if anybody is doing a deal in Texas or you're outside of Texas and you need Scott as a consultant or something like that, reach out. Don't bug him too much, but you're busy, but get a hold of him because he could help you guys. And you could see why is because you're not going to run into guys like him. So when I started off today's call saying Scott's the best in the country, even though he gets mad at me for saying that, you can see why I say it. And I deal with attorneys all the time and
Oh, I'm sorry.
oh man, I wish I had you in New York. I wish I had 10 of you in New York State. It'd make my life
Yeah,
so much easier.
I'll stay away from New York, but I would say one quick thing. We have a website called the Owner Finance Network, which is just lists all of our services on there, whether it's legal or title, RMLO services, statewide, nationwide, loan processing, loan servicing, the whole 9 yards is on there. Other things for Texas specific. And about 1,500 videos are on there that are free, by the way, on our YouTube channel, all about creative finance, buying, sub-to, selling, whatever it might be, and everything in between. They can all go to that, and it's theownerfinancenetwork.com. We don't try to sell anything on there. You can buy some webinars and seminars if you want to, that's fine. Because eventually you're going to come back to us for our services because you have to have those. And instead of charging $10, $20, $30,000 like some people do for that, we try to provide more of a service to our community. So it's a great thing to do as well. But guys, thank you so much.
Yeah, we'll make sure we have all of that. If you didn't write that down, the notes will be in the portal. We'll make sure this episode gets uploaded. Special place, all of these show notes, and then obviously the links. So
we were so excited for you to come on. You just blew everything out of the water. So thank you again, Scott.
Oh, malarkey.
And shout out to Susan for helping put all this together because, Scott's amazing, but you can only be as amazing as your team around you. And Scott has an amazing team, and I've always loved Susan. She's been amazing. So,
well, I have an amazing, what y'all don't know is I bought out my old partner, Dave Arant, of 25 years, 10 years ago. He wanted to move on and do some things differently. It was great. He's still one of my best friends. And within 2 weeks of me buying him out and finalizing, I'm at an REI event, and here comes Susan, who I had met one time at a La Madeleine restaurant, who they were trying to figure things out. She and her 2 partners at that time. And in one meeting, and within a week, we went in and boom, I have never given up 50% of a company before from everything we do. And we have quadrupled in size almost since bringing her on board. And it's realizing she and I we are peas in a pod, baby. Let me tell you what, we can bitch and moan at each other like you can't imagine. And then on the other hand, it is as far as the East is from the West, different in other things we do. And it makes one of these unique, and I have to say, I know she's not listening, but it's this unique environment. And I would tell everybody, try to find, it's truly a compliment. We really are so different, and we are so alike. It's weird. And we have our little spats,
No.
pair of boxing gloves in the office here that I call our, anyway, that we hang up. It's our dispute resolution mechanism if we have to ever use it. But it is, and it's amazing what you can do with the right people. And sometimes for everybody, it's recognizing you can do a lot more together than you can apart.
So
You
true.
really can.
Yep. Yeah, what a wealth of information.
I'm going to re-listen to this.
Yeah.
Oh, whatever. But anyway, guys, thank you for letting me come on. I love doing this stuff.
Here's something else. Thank
Whether
you.
it's here or later on, we always like doing it. I love to help anybody answer any of their questions. I love doing Ask the Attorney sessions where they just ask the questions. it's fun to do those kind of things. But anyway, I appreciate it. And thanks to your entire audience. Look forward to seeing you guys again. Just wait for that invite to Sarasota.
I'll tell you what, you tempt me with a good time. We might also go to Texas because I used to live in Addison. She's
Really?
never been to Texas.
I want to go so bad.
And then when I tell her
What?
that she's never had good barbecue before because I live in Florida and we're from New York and they don't even know what good barbecue or Tex-Mex is. And um
Wait. Jen, have you not had Tex-Mex?
no,
What
No.
is wrong?
there's
It's never taken me to Texas, nor have I gone.
And-
So
And barbecue, oh my gosh.
it's the best. It is world class. Y'all got to get some good Italian food there. Maybe it's gotten better over the years, but the Tex-Mex and the
Tastes like-
barbecue are world class. So now you're just another reason, Donnie. We've already chatted about us going to Texas.
Yeah.
Come see you, get
Making
some
it
good
happen.
food.
We
But
would love for y'all to come and say hello.
Oh
It'd
my
be
gosh.
awesome. Anyway, thank you again so much, guys. It's always fun doing this. Look forward to doing it again soon.
Awesome.
good.
Thank you. And thank you everybody for tuning in. We will see you tomorrow. Don't forget, go see Brittany tomorrow during her call. And you guys are awesome. So if you have anything, drop it in the questions and the WhatsApp, and we'll see you guys tomorrow. Thank you once again,
have a good
Scott.
night, Scott.
Thanks, guys. Y'all too.
Hey, everybody.